Hi, I'm Piet, the chairman of RCM. What I want to talk to you about today is an investment strategy for 2013 and beyond. In other words, a long-term investment strategy. Now, in our opinion, an investment strategy needs to deal with quite a few things going on in markets today. The first is it needs to be able to deal with this high level of economic uncertainty we're all faced with. Now, there are a few ways of dealing with this. Many people try and forecast what's going to happen in the near and far future and then put together a portfolio that can deal with whatever their forecast tells them is going to happen. We regard this, in the words of Nicholas Taleb, as a fragile type of strategy, because if your forecast turns out to be wrong, your portfolio will not perform very well, and it could actually lead to large losses. The second way of dealing with economic uncertainty is to put together a diverse portfolio of cheap, undervalued assets. Again, in the terminology used by Nicholas Taleb, this would be a much more robust type situation. It's robust because without forecasting the future, a diverse group of cheap assets will deal with anything the future throws at it. Some of them will do well, some of them will do less well, but on average, such a portfolio should move forwards over time and will not lead to large losses. That is why it is robust. So that's the first aspect of portfolio strategy. We need to put together a robust portfolio of diverse cheap assets. The second thing an investment strategy needs to deal with is this whole issue that we sit today with, and that is the one of financial repression. I think you've heard this word used many times before. But basically what it means is that governments worldwide, in conjunction with the monetary authorities, are placing downwards pressure, repressing interest rates to force investors into higher risk, higher yielding assets. Effectively, what they are doing is surreptitiously robbing investors to pay for the profligate governments and other economic entities' debts. So that is in a nutshell what's happening with financial repression. We think a robust investment strategy should be able to deal with this. How does one deal with it? Well, you need to avoid being coerced into buying relatively high yielding assets in the hope of generating income, because that's exactly what the monetary authorities want you to do, and the effect of that is to force you to overpay for these assets. So we think a robust investment strategy would avoid yielding assets at this point in time. Remembering that the search for yield generally leads to large losses. We only have to think back to the economic crisis, financial crisis of 2008. The reason that happened was, or one of the reasons that happened was that investors were accepting higher risk in the form of collateralized debt obligations, which were rated AAA by the rating agencies, but the risk wasn't being priced correctly at that time. Again, that was a search for yield that led to that outcome. So our robust investment strategy is avoiding this search for yield, which is being forced upon us by financial repression. The third thing a robust investment strategy needs to be able to deal with is conventional wisdom. And this follows on from the previous point. Conventional wisdom today says we need to invest in quality yielding assets. That is the name that conventional wisdom has given to the strategy that everybody is following. Now, in the past, conventional wisdom has led investors over many cliffs before, and every time that cliff has had a name. Just thinking back about 20 years, in the mid-90s, the name of conventional wisdom, or the name conventional wisdom had given to the strategy that one was supposed to follow, was buy the Asian tigers, because Asia would grow faster than everybody else in the world. Then we had the whole IT bubble. The name conventional wisdom gave to that was the new economy. You had to buy technology stocks because the new economy is going to change the way we do things and would lead to growth as far as the eye could see, according to John Chambers, the CEO of Cisco at that time. Then we had the conventional wisdom here in South Africa of buying rand hedges in 2002, 2003, when the rand was at 15 rand to the dollar and it would go to 30 rand to the dollar shortly, and you had to get out of South Africa to ex-growth. You had to invest all your money in the UK and the US and other developed economies in the world. The conventional wisdom was called buy rand hedges. Then we had the conventional wisdom, which was called the commodity super cycle in 2007-2008, just before, of course, the financial crisis and the collapse of commodity prices and any assets that had to do with that whole cycle. So you can see that conventional wisdom is a comfortable place for investors to gather, to hold hands, but ultimately leads to large losses. So a robust investment portfolio needs to recognize conventional wisdom, needs to recognize the name given to conventional wisdom, and needs to be able to avoid that, because conventional wisdom leads to highly priced assets, which of course leads to losses down the line, and a robust strategy does not want to suffer losses. So that's the third aspect. Avoid conventional wisdom. Today's conventional wisdom is called quality income, which again leads to the fourth point a robust portfolio strategy needs to deal with, is this artificial distinction we as investors all make between income and capital gains. We think investors should be focused on total returns. In other words, the combination of returns generated by both income or yield and capital gains. At some points in the cycle, yield is cheap. At other points in the cycle, income or capital gains is cheap. Today, we think yield is expensive while capital gains, in other words, assets that do not pay dividends, that have no yield, these type of assets are very cheap. Now, if we think back to the first point, putting together a portfolio, a diverse portfolio of cheap assets, today the cheap assets reside in the capital gain spectrum, not in the yield spectrum. So our portfolio will consist of assets that pay very little in the form of income, but that have large potential capital gains in the future, maximizing total return. Now, of course, the question is, as an investor, I need income. What do I do? Well, we think when capital is priced cheaply and income is expensive, you can sell off a portion of your portfolio every year to generate that income. It's the same thing, whether you're selling off a portion of your portfolio or clipping coupons or gathering dividends from the investments in the portfolio. Now, Viljoen will deal with this a bit later on in more depth. He has applied his mind to this and has come up with some interesting numbers, and he will talk a bit more about that. So have a look at his video if you want to find out more about our views on the artificial distinction between capital and income. So in a nutshell, putting this all together, an investment strategy which is robust needs to deal with economic uncertainty. It does so by buying a diverse portfolio of cheap assets. It needs to deal with financial repression. It does so by avoiding the yielding assets which we're being forced to buy by governments. The third thing a robust investment strategy needs to do, it needs to deal with the dangers posted by conventional wisdom, and we think today's conventional wisdom is that of quality income, and we think a robust investment strategy avoids that conventional wisdom. And the fourth thing it needs to deal with is the artificial distinction between income and capital, and we think by focusing on total returns, it can do so. Thank you very much for your time.